Well, we've been up this week, kind of been down this week. Had some good volatility. You know what? We're still green on the week. We're still holding some major support. Big problem is we can't hold the rally. We'll find out by the end of the week, maybe if this 39.50 area is going to hold. Moss sold some stock, and I know someone who sold some stock too. We'll talk about that. We got some economic numbers. We got some market structure talk. And we got our boy Blue coming on at 8:35 to put this whole inflation interest rate scenario, make it easiest for understand. I'm back. Mitch, roll the intro.
Coming to you live from downtown Detroit, this is Benzinga's Pre-Market Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I'd buy that stock for a penny.
With everything you need to start your trading day.
All right, let's run down the commodities in the futures. The SPOs are taking a hit. We're down 38 handles at 39.92, just treading above the pre-market low. The buck perking up 55 cents at 104.29. TLT in the red. That's in the red by 52 cents. Crude distanced itself from 70, up 19 cents at 77.47. Gold just couldn't stay in that 1800 handle, down 31.70 at 17.87. Silver, that's a big move in silver, down 78 cents at 23.35. And Bitcoin, after moseying up to 18K, it's down $120 at 17,675. Let's bring Triple D out of the to the show, out of the trade cave, and Money Mitch. How you guys faring today?
Not too bad. I mean, it looks like the market might be a little bit struggling along and war concerns out there, but at least myself, not too bad. Just on the sidelines.
I'm still on COVID, so I'm not getting rid of that position anytime soon. So still on COVID. Should write some puts against it though, but I mean, or maybe some calls.
Do you test and get anything or not?
No.
No.
I tested positive 3 months ago and I never got better. So I just stayed congested. So I feel fine. I'm just congested and I cough up phlegm. So 3 months.
Or it could just be the winter, man. We need to get you to Florida like Joel or something.
There's probably,
I'm going to Florida. Let's go.
On vacation. I probably would actually get rid of this thing.
You know what we need? Guys, we need the pre-market prep winter experience. It's actually in Florida. We got to bring you guys out here.
Let's do it.
We got to do a little planning in Orlando or maybe even Key West.
Florida. Let's do it. Get me a trip to Florida because I actually think maybe then I would get rid of this.
Yeah, you need the sea breeze.
The sunlight. There's no sun. Where I am, the sun just doesn't exist. There's no sun.
That's the one
maybe
thing.
I need sun.
Always. Yep. Sun's a must.
I sure hope there hasn't had mold in my house. I sure hope not. It's only 3 months old, so I sure hope there's no mold in here.
Well, I'll tell you what, guys. Did Jerome Powell just say that forget Santa Claus, we don't need him?
No.
Because it seems like that's what Jerome did yesterday.
He did, yeah. You're right.
Fed coming in, raising by 50 basis points. I don't think that was unexpected. I think everyone expected to hear that. Now, where you get some unexpected, of course, is the longer terminal rate going up to eventually maybe 5.1. That's where some people might have had it wrong. Other kind of statements that he said that I think are significant are statements like doesn't have a plan to pause or take a reversal path, pretty much taming everybody that said that this was a pivot. Pretty much just said it like, I don't even have a plan to pause, let alone talk about a reversal path.
Yeah.
I don't know where you guys are getting this.
And this was common sense. Like, I don't know who would have thought, we're good. We got the inflation ticket down now. We're going to stop rates and we're going to probably start lowering them soon. You think he's going to say that? It's counterproductive to what he's trying to accomplish. Dumb
And
money
there's one
was
more
saying that.
important spot that he clearly continuously keeps saying. He said it again in this conference. He said that we have tightened significantly in the past year, but the Federal Reserve policy isn't sufficiently restrictive yet.
And they hit it on that too. Yeah.
Boom. Because that means what? There's more down the line. If he's clearly has said that he's been trying to get it to a restrictive policy, and he's clearly saying it's still not even there yet. We still haven't even gotten to the spot where we could consider it restrictive. So there you guys see the outlook from Jerome Powell.
Hawkish
Definitely
Powell.
coming
Yeah.
like a hawk.
Full on hawkish. Joel, you've been away for a couple of days here. I know you can't ever get away from the markets. I'm assuming you've been watching, obviously, the price action here as well. We've given our thoughts the last couple of days of the price action. I was very concerned that they could not hold the CPI gains. I was very concerned enough that I tweeted when we were 402 SPY that I think there's significantly more downside here now. We're 70 handles lower from when I tweeted that 2 days ago. Obviously, we chopped around yesterday, a lot ahead of it, and then we sold off with the Powell. What are your thoughts here coming in?
My thoughts is that they're on these rallies, these ridiculous rallies, like the one that you had on Tuesday, that they're firm sellers out there. Like there's orders on the books, like, get me out of XYZ at 92, and that order is staying at XYZ no matter what. Whatever the SPOO's orders are above, they're firm orders on the sell side that are going to get executed. And then on the downside, you do have a level of support, and basis the S&Ps. I'm just going to call it like right around 39.50, and then for the SPY, let's call it 92.50. I mean, that's where your buyers are at. They're not, they're not stepping out. They're maybe they're in for the flip, but it just seems that the market participants know where they want to sell, and they have a support area that's holding, but it's just not the demand underneath. So I just will look at last week's low, whether it's the spider or the S&P. It takes out last week's low. I think we got some more downside. We're still up for the week. You mentioned a trading range, but it just, there's sellers out there, and there's big sellers, and there is some buyers, but you have come 500 points off the low. I just don't think anyone's the huge appetite for to get long and get long at these levels. So that's what it feels like to me.
I think I'm going to start too much risk. Mitch, go ahead. I think that I can't. This is why I stay heavy at cash, because I can't assess the risk here. I mean, if we do go into a recession, these stocks aren't cheap. So I mean, risk reward. Everything is about risk reward. Entire life, your life is about risk reward. You go out, you go take your kids, you go somewhere, you can risk a car accident. It's a very low risk. That's why you take that chance. But everything is risk reward. When I assess the risk reward of the markets right now here, I just see so much downside potential, and I see some upside potential. But especially that's why I was treating some of these stocks are all-time highs. I mean, is this really do these stocks have business being at all-time highs? And people get mad at me and say, oh yeah, those are the ones you got to buy, because everybody's learned just momentum trading. Everybody just follows that book. But really in 2022, the reason that I've been very successful in 2022 is I've taken a contrarian approach, where some of your momentum traders haven't done as well because momentum doesn't have follow through. So we've had a really nice rally in all the Dow stocks in the last 6 weeks. I mean, it's been an incredible rally, up 15% in 6 weeks. They're still trying to hold on. But I just look and say, the next move, if you're buying Goldman Sachs here, maybe we use the Deere example because I was using that before. I mean, it's at all-time highs, Joel. I mean, do any stocks really have business being at all-time highs right now?
Is Netflix going out of business right now? What's going on here? We've just had a pretty big drop here.
Netflix just got news here.
Yeah, what do we got?
You guys, let's find out.
We're all over the place.
I
just
right.
text. We're talking Netflix.
I'm sorry.
You're right. Netflix. There is.
I mean, there's something hitting, but I don't see it. I don't see it in the tape
yet.
Yeah, there's nothing at least on my tape here.
Report. No, there's always news. There's.
I'm not saying it doesn't exist, but more.
There's a
I don't have
report coming out, and obviously, there's a report coming out that I'm just trying to grab it, and I'm just grabbing this from Twitter here right now. That there's rumors that they're missing their viewership targets. So
Yeah,
I'm not sure if that report is real. I just see two people talking about it. It's from DigiDay. I don't know.
Well, Jeffries put out
DigiDay.
something yesterday at 1:40 that says sees potential subscriber miss and waiting for ads to develop. But I don't see anything else.
140 yesterday. We're talking about a move right now. It's down
but I'm saying
$16. It's down 5%. That is not just, it's market effects. This is news. DigiDay. I'm giving you what is the headline that's moving. I don't know this company. I don't know this website.
DigiDay,
but DigiDay is saying that they're missing their view. Netflix lets advertisers take their money back after missing viewership targets. I see 3 people talking about it on Twitter. I do see the article here. So it looks like this is it, unless there's something from another source, which we're still to be determined here. That's what they're talking about on Twitter here right now. So whatever the reason, 5%.
I don't even know what the hell DigiDay is.
I don't know who DigiDay is either, but people see missing viewership targets and they get scared. I could see Zozo, who watches the show, is tweeting about it right now. There's lots of people on Twitter. So I want to give you guys a hint. So Benzinga Pro, we obviously, get our news from the wires. We get our news all over the place, but we're still people. We're not always going to be the first ones. If you're looking for quick news, sometimes you got to just go to Twitter too. Hit latest. So type in your ticker on Netflix, $NFLX, hit latest, and see what social media is talking about. Not that they don't usually it will hit the major news wires first, but when you don't have anything on the major news wires, it's always a good source to just go quickly. It's free. Go check the latest on Twitter, and sometimes you'll find if you see 3-4 people talking about the same thing, that's likely the reason.
I'm looking at the price action here, and 302 is kind of sticking out to me. Now, we did get below 302. If you're looking at Mitch's daily chart, you see 3 lows between 301, 301, 302, 303. That's where that was where the daily support is. We did take that out in the pre-market. We did get under 300, I believe. So if the bulls want to, defend their stock here, they're going to defend 302. If not, then you got a big, ugly, well, no, it was a nice bar on the way up, but you got a big green bar on going back a couple weeks ago where your next daily low was 280. So that's the next daily low, but see if, that's a quick windfall for anyone who's been shorting this thing and been getting jammed. So we'll see if the pre-market low holds. That 280 number is not a good number. But definitely trying to rebound.
And I don't know who
we're getting hit.
is.
We got 815 number here. Obviously, Dennis, watch out. We're bouncing around pretty good here. We had something coming out at 815. Man, what are you guys sleeping all week?
We're gonna get to the tick sizes, folks. People want to talk the tick size or ask about the chat.
I mean, the tick sizes might have to wait, team. Because
they're gonna have to wait.
We'll get to that. Yeah, we'll get to that.
What's the number that just came out here?
Just another
5 points.
Go ahead.
It's. I wanted to give us the Netflix news, but I guess I'll give us this one here too.
Why? Do you have okay? Stop. Do you have other Netflix news?
Yeah. I was gonna give you exactly what's in there that's probably causing the hit. So what it's really is saying that they're not meeting their viewership guarantees that they put to advertisers. Netflix has only delivered roughly 80% of the expected audience, and they left room for advertisers to take money back from ads that have yet to run if they're not meeting certain traffic numbers.
This is from the DigiDay article.
Yeah, that's what's in there.
That everybody is talking about right now.
That's the meat of the article there, and why things are running and why they're kind of running out of that. Let's take a look here. 815. I know I had a lot of 830 numbers, but
yeah. It can't be. I mean, the ECB raise. That was a while ago.
Yeah, that was earlier. You're right. That was at 7. I was in the 7 handle. So I'm not sure. Maybe we're just chopping around here, but they're talking about breaking news. ECB raise. No, that it was bank, wasn't it? Wasn't it?
Oh, it was
Bank of England earlier.
England. Okay.
England earlier.
Yeah, that was already done though. So I guess
ECB right
raising also. So everybody raising because they're following our Fed. It usually happens.
Put Draghi back in there.
I'm trying to get some of the news, but even my platforms are having some issues right now. So
no, that's the ECB. Yeah, I was just confused because the
Bank of England was earlier.
Yeah, so another
And there's war updates that don't sound good either, right? Did you hear about what the Russian embassy was sending in?
What are they
Giving
saying?
die warnings that if we give Ukraine the Patriot anti-aircraft missile system that right now is going through the last kind of process through the Pentagon, they stated, if this is confirmed, we will witness yet another provocative step by the administration, which could lead to unpredictable consequences. So I'm not going to say that that's going to lead to anything, but I know that a lot of people have just stopped even the news, not really focusing on what's going on with the Russia-Ukraine situation. I think this is definitely an update to focus on because we keep giving them more and more. At some point, Russia's going to be like, this has to end. But we'll end up finding out what happens in that situation. So keep in mind that it is getting, I think the situation's getting worse, not better.
Yeah,
just
there's
just
more. That's more things to worry about. I mean, maybe this market climbs this wall of worry, but it hasn't been climbing the wall of worry. You know, sometimes when these markets that climb walls of worry, this market hasn't been one of them. So going back to the Netflix, you know, I sold my Netflix out of my wife's account there at 307. It was like one day before the big upgrade. Who upgraded it? Who upgraded and made all their listeners or all their viewers bag holders?
I think it was Morgan Stanley. Was it? Was it Morgan?
I don't know. We don't want to call him. I want to call him out because I was like, wow, that's a bad upgrade.
Upgrade on Netflix?
Yeah, 4 days ago.
All right, I'll pull it.
Day after I sold it, because I was so ticked off. I was like, it popped to 320. I was like, are you kidding me?
So they were watching the show. They heard you sold it. They were like,
yeah, probably. They're just waiting for me to sell. And then they're like, okay, Dennis is out. Let's upgrade this stock now. So going back, it was
Wells Fargo.
Wells Fargo.
Wells Fargo.
On the 9th.
I think they're so late to the party here. I think all the easy money, and this is why I sold my Netflix. When I bought the second pricing, the P was 17. It's went up so much, the P is now 27. So it's multiple expansion has happened here. I think we're going in recession. At the P of 15, 16, I kind of liked. P of 27 just got too expensive. So I sold it purely on valuation. No idea why they wanted to upgrade it at 3.0 or 3.11. They're down now on it. Deserved. I think Netflix goes lower from here.
All right, we'll get out of Netflix.
Although this article, I don't know. So maybe it bounced back because I don't know if anybody really knows DigiDay. So I wouldn't be surprised. I wouldn't be surprised if we do bounce back a little bit here. I'd sell in any strength. Just my opinion. I already sold it. So I'm selling into strength on Netflix.
Bottom of yesterday's range, 314.42. I don't think we're going to get there. 300 is the exact pre-market low. So I think that's and there's probably some stops there, you know, like, well, I'm riding this up. I'm not going to sell into strength. But if it gets under 300, get me out. So I think that's where plus the SPOOs are certainly not helping out any stocks right now. We are coming down to the lows of the pre-market session, 39.80. We're talking March contract now, folks. I converted, and the other thing, at least I'm back for the quad witch on Friday. This should be fun.
It's triple witch. We don't talk quad witch.
Okay.
We talk
triple witch back in the day. Okay. I stand. There you go. There's the triple D. You know, getting a little bit fired up.
Smack you around on that.
I hope you guys yelled at each other.
You guys got it all wrong. You guys got it wrong.
Did you guys yell at each other at all when you were gone or not? You guys,
it's not the triple witch. It's not the quad witch. It's the triple Mitch.
There you go. The triple Mitch. Well, triple Mitch. Are we going to talk some ticks?
Yeah, let's talk some ticks.
All right, let's turn it over to Dennis on this one.
Let's take a second. Yeah, this is the Dennis. Look, we'll put
bring up the chart
right in center there. All right, I'll bring up the chart for you.
I want to bring up the chart. I don't want to see my mug shot. I can't.
I got you. I got
myself. I want to see my chart. So he's going. I tweeted this chart last night. So lots of market structure happening. Lots of proposals. The most that they've probably done since Reg NMS, which was basically 14 years ago. So they look like the SEC is doing a big overhaul here. They're trying to go after the off-exchange market makers. And you know what? I applaud them for that effort. I'm somewhat concerned with the reasoning why here. So not looking at this tweet, but go down. There's if you go to the next tweet, you'll actually see a chart, Mitch. We're looking for the chart. So I took a snapshot from the 300 pages just on the tick sizes. So
is it in a thread?
Down, I know I tweet a lot.
Or is it on your
no, keep going.
Man, this guy.
There it is. There it is. Stop. Go back up. Click
This
that.
one?
Click that. It's not a chart. Click that.
All right. So this
Zoom it in.
All right, I got
You
you.
can see the buckets.
Zoom
This
in.
is from like page 8. I leafed through 300 pages of this for you guys.
Man.
The tick sizes last night. This is just the tick size part. It's not talking about any other parts. It's the only part that I had time for last night. So if you zoom in, and he's trying to zoom in here, maybe
I have to open it up because it's small here. So give me a second there.
Okay.
Boom, I got you.
I didn't throw you under the bus on this one, Mitch. I told you on this one, but okay, there it is. So you got 4 buckets. So what's being proposed is they're going to lower the tick sizes. What that means is there's going to be more pricing increments per handle. The reason behind it is really the reason behind it, maybe not the reasons they said, but I know what the reasons behind it are, is your off-exchange market makers are sitting there on a stock like Bank America, and they're buying on the bid, and they're selling the offer directly from retail, directly from Robinhood, and they're making the penny all the time. They're sitting there, tick, 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 tick. So they're printing on the bid, they're printing on the offer, a little bit of sub-penny price improvement. So what they're doing is they're trying to narrow the spread so the off-exchange market makers don't make as much money. It will do that. It's actually not a bad proposal in that way. My concern is that the tick sizes are going to be annoying for human traders because if you think the markets are fast now, they're going to get much faster. So let's look at the bucket. The first bucket, 0.001, and it's for spreads if you time weighted average quoted spread of under 0.008. So for the most part, that's probably mostly your stocks under $1. So I'm not too worried about that bucket. It's the next bucket that I'm kind of worried about. Because for this, the time weighted average quoted spread is going to be between, if it's between 0.008 under this test period that they're going to be doing, to 0.016, it's going to drop to a 0.002 bucket. So a stock like Bank America will definitely fall into this bucket. And what that means is Bank America, quoted typically 31.92 to 31.93 when the stock is open, is going to be quoted 31.922, 31.924, 31.926, 31.928. So you're going to have an extra 5 pricing increments per penny, an extra 500 or an extra 400 pricing increments per handle. So there'll now be 500 pricing increments per handle because currently we have 100 pricing increments per handle on the exchange with the 100 decimal with the pennies. Now we're going to sub pennies. So that's the move into sub pennies. And we'll get Joel's thoughts on this too because I'm sure he'll have some thoughts. Amazon will probably fall into this bucket as well. It's going to be close, but because sometimes Amazon's trading with a 2-cent spread, but normally if midday it's trading with a 1-cent spread. So I wouldn't be surprised if Amazon gets caught in this bucket too. So just thinking about all that, obviously the quotes are going to move much faster, because you got algorithmic traders that are going to be jumping around each other for Q position. What we had was back in 2006, before Reg NMS and the sub penny rule, we had sub pennies. They were out there, and they made SEC Rule 612 the sub penny rule because the quotes were changing so quickly you couldn't follow them. So what they were calling it, and what a good name for it, is quote flickering. So I think you're going to reintroduce this problem. So I like the fact that they're trying to go after the off-exchange market makers a little bit. I don't like the fact that you're going to speed up the quote, and now we're so much more algorithmic than we were in 2006. You're going to have those high-frequency traders that are on the exchanges sitting there just trying to jockey for a Q position, going back and forth, back and forth, back and forth. And it's going to change your quotes so rapidly. So you're going to try to hit the 90, not 117.2. Now it's 90.17.0. Oh no, we got to try to hit that. So it's going to be kind of annoying for a human trader. I think the high frequency traders on the exchange will like this. I think the human traders are going to struggle with it a little bit. But I think the SEC estimated about 1,700 stocks will fall into the 0.002 bucket. Stocks like Amazon will fall in that. A stock like Johnson & Johnson will probably fall into the 0.005 bucket. So J&J will be 179.765. So that's a little more. I think I would have liked it if they just stuck with the half tick. But when you get down to 0.002, it's almost too many ticks.
For us, Dennis, that are maybe not so into market structure or just want to keep it simple here. So you're telling me here that the advantage goes to more the algorithmic trading than the retail trader?
Yeah,
that's what I kind of want to get to.
I think that's what they were trying to accomplish. They're trying to knock down the profit margins on the off-exchange market makers, and I get that, and I think it does accomplish that to a certain extent. My concerns are that they're gonna have this quote flickering problem where the quotes are changing so fast they look like they're flickering. So
yeah, like
if you think
Plan
the quotes
B.
move fast now, they're going to really move. They're going to move 5 times as fast. So on a stock like Bank of America, because it's going to be 5 times more pricing increments. So that's my concern. I mean, obviously in practice, maybe it's going to work out to be different, but we already went through the quote flickering problem in 2006. I didn't like it. I was happy when they put the sub penny rule in, and I believe it was when Reg NMS came in 2008, and that's 14 years ago. They kept the spreads a little bit artificially wide. Should Bank of America be a half tick? I think so. I think they went a little bit far with the 0.002. I think they should go to the 0.005. But bottom line for you is you're going to see stocks quoted a little bit tighter. On a stock like Bank of America, again, it's going to be in the middle of the day, it's going to be 31,882, 31,884. For the potential. I mean, it doesn't have to be quoted that. It's like somebody still has to put a bid or an offer there. But we have the potential for now 500 different pricing increments per handle.
So my recommendation to go back to nickels is not looking pretty.
They went the other way.
Yeah.
They went to sub pennies.
Yeah.
Sub pennies for everyone.
This is, I mean, I think it'd be an absolute nightmare for traders. I mean, you're not
for the human trader, it's going to be difficult.
Yeah.
All right.
I mean, you'll just go with.
I think the algorithms will love it. I think the human trader is going to struggle with it.
What you mean? Like, what should I be? 31,8802 or 38,881 or 30? Yeah,
three decimal points.
I don't. Dennis, you probably won't do. You'll just go like 31,89 and see.
Yeah,
if you can get
that's how you're going to have to get around
that's
it.
What you're
going to have to
do.
ignore the middle stuff and just want to hit the bid 37.84. Don't put 37.84. Go 37.8, like 844.
Round it up.
37.84. Yeah, round it to penny, and if you get the extra, that's good. But don't try to sit around for the extra 0.02.
You'll never get it.
I think that's how you have to get around it. But again, we've had 24 hours to think about this only, and there's been a lot going on in the last 24 hours. I get what they're trying to accomplish. Again, on a stock like Bank of America, you got, the off-exchange market makers are saying trading between the spreads.
Dennis,
I'm just going to interrupt you here because it's at 8:29 already. You got about 30 seconds for job numbers coming in here. Sorry, team. Want to make sure that we give you guys these estimates before they come out. Initial jobless claims estimates 230,000, prior 225,000. Philadelphia Fed Manufacturing Index estimated -12, prior -19.4. Retail sales November estimated is -0.2, prior 1.3. We'll see what happens there.
A little bit.
Also getting core retail sales
a little bit
at the same time. There's going to be a lot going on, a lot of numbers coming out at the same time. So there might be a little bit of time to filter through this. Let's see what happens here. Overall,
77.50. We just hit 77.50. That's low. I have nothing in there for you, folks. But once those numbers came out, I can't tell you what any of them mean. But someone came in with a bid. They came in with the bid here. 77.50 is the low. They're trying. I wish I could we were hanging out at 39.90 when I came in this morning. So I'll call that minor resistance, but do have some buyer. You do have some bottom fishers here. I don't know if we're going to be able to get back to 4,000 off this, but Mitch, I just wanted to describe the price action there. Off the number, you made a low, but you're finding buyers. Go ahead with the actual information that.
All right, so
very hard to understand.
Yeah, we got initial jobless claims here, 211,000 versus 230,000, coming in light. That's not a good thing for the markets. Retail sales coming in at -0.6% versus -0.1% expected. Not good here, at least on the first two numbers that I'm getting here. Let's keep going through the numbers. Next one would be core retail sales for November at -2 versus 0.2 expected. Also not a number that is good here. Continuous jobless claims at 1.67 versus 1.671 million expected. So continuous jobless claims not jumping higher, which is what we kind of want to see for the job markets coming down. So another number that points to me to the downside. You got New York Empire State Manufacturing Index at -11.2 versus the -1 expected there. Not looking good in manufacturing index, showing some contractions, but that could be a good thing, right? Because that one's actually more about the manufacturing, how you're seeing contraction there. So that shows a slowing economy for the New York Empire State Manufacturing Index. And you guys can see it here from all these numbers that are coming in. It's not just one, right? So it's going to take a lot to kind of decipher through here. We'll have to keep watching what's going on with the price action. Like always, that's going to help out determine how you see and how investors are seeing it right now. One thing you can see is look how the spread is even tight right now. A lot of times we don't even have that tight of a spread. We didn't really move much.
Yeah, really, it did, Dennis.
It went 70. SPY went 70 cents wide at 8:30. There was nobody in there, and now the algorithms come back in because it's safe. They pull as soon as there's information. I do too, and then when it's safe, they come back in. So I looked at one point we were 70, not 7 cents, 70 cents wide on SPY. We would come back in here now. So obviously they've got a feel for it now. New information, they go wide. Where's it go wide? Right, they pull their bids and offers, and then they come back in when they feel like it's safer.
Yeah, I'll be looking for a 394.50. That's kind of like the underneath support here from this candle on the 1 minute. You got 394.50 exact at 824. We'll see if we take that out on the downside. Upside levels to look for. What would you be watching, Joel?
I mean, you can't get excited about this market until you get back over yesterday's low, and that was 97 1/4, and that's 17, 18 handles from here. And I did the levels this morning. I don't have a good number for you on the downside. Your close last Friday was 68 1/4, and then you have all those major lows. But I know we got our guest coming on in a second. Dennis, Lombardo 141. Is asking you if the new tick rule means stocks will move slower. And I think what you said, it's probably going to be the opposite, right? It's
the quote will move faster. The stock prices themselves, I don't know if it gets impacted that much because you'll just be thinner at each pricing increment. So what I mean by the quote moving fast is the bids and the offers are going to move a lot quicker. On some of these, they're going to move 5 times as fast because there's, options to go to 500 pricing increments versus 100 pricing increments. I don't think it affects how the stock moves overall. You just thin out the liquidity. When we were teenies, Joel, you can remember when we were 8s.
I remember
you have liquidity that bulks together. And now teenies and now sub pennies. I mean, liquidity, it's going to see small orders all over the place. So you don't see it bulked as much. So that's where, because there's more options of prices to put. So anyways, that's my thoughts. I'm concerned about the speed of the quote changing, just that, retail traders can't get a grasp for what is the price, more so than I'm concerned about, stocks not moving or moving further.
All right, let's keep going. We'll get out of this right now. We're going to get into our guests. It's 8:35. Like always, it's everybody's favorite time. It's time to have some time with our boy Blue, CME Group. Let's get it started.
Come on, Blue.
Yes, you guys see it. Blue Putnam, Managing Director, Chief Economist, CME Group. We got you back, Blue. We need.
All right, thank you.
Definitely.
Holy Blue, there's so much to talk about. I mean, just taking in the information that's come into this market in the last 48 hours, from a CPI report that came in light to hawkish Powell, which everybody was hoping was going to be a little more dovish, and that did not happen yesterday. I want your thoughts on everything, Blue. What are your thoughts first on the CPI and then on what Powell was saying yesterday in his conference?
All right, here we go. The CPI. CPI, great number. We peaked in June. We've been coming down every month. So this is not 1 month's number anymore. It's not 2. It's not 3. It's 4 or 5. So there's good news on the headline. Core inflation still a little bit sticky, but everybody knows why. Shelter prices, and we already know the housing market's coming down. So that's really not a concern. So this is good news for the Fed, but they had a credibility problem when they used the word transitory too often about a year ago. And so, they can't change their guidance month to month. That's not what they want to do. So Powell's going to stay probably with what he said yesterday and stay with that. But they got to be feeling better that the inflation's coming down. And then the economy, I'd be careful with that retail sales number. It was a negative number. Retail sales, we're in November, December holiday period. People are moving their purchases. We don't know whether they're moving them up, moving them back. I would argue that the economy is slowing a little bit, but you don't see that in the hiring and firing on the job side. And the reason is, when we came out of the pandemic, a lot of companies had trouble hiring people. And so that means they're going to be a lot more reluctant to get rid of anybody because they know hiring them back is tough. So we're getting some layoffs in a few sectors, but we're still getting hiring in others. So job market's fine. Retail sales are a little slower. The inflation news is good. It's all good.
And the market's getting killed off it.
Yeah. Well, it doesn't sound that good when the market's getting killed off it,
I don't.
Hey,
well,
it was holding that level for a second.
There's a lot of room for maneuver between the economics and what the markets decide to do.
That's
but
true.
The Fed's telling us that they got a rate rise or two left in them before they find where they're comfortable. I mean, Powell talks about sufficiently restrictive. Most people think, well, that's either 4 3/4 or 5, something like that.
Okay.
Not really, and there's really no difference between those two. A quarter point's not going to matter to the economy. And I don't think a 5% Fed funds rate means a recession. Obviously, the yield curve, the 1 year is, I think, about 114, 115 basis points higher than the 10-year. So that's screaming recession. But you have another interpretation, and the other interpretation is, hey, wait a minute, inflation comes down faster than you thought. That's already happening. It's coming down faster than most people thought. And so maybe inflation comes down and the Fed can adjust because, it is data dependent. So anyway, I understand why the markets are still nervous because Powell's still using the word sufficiently restrictive, which is, I think, code for at least a shallow recession. But the data that's coming in, you got to be pleased. The inflation really is coming off.
All right. Well, definitely Go ahead, Joel.
No, go ahead, Mitch. Go ahead. I'm sorry.
All right. Well, definitely we've been starting to see inflation start ticking down, and you were definitely in the camp. I think it was June when we were talking, or maybe it might have been July, where we were talking about how a lot of the times this economical data that's coming through has a long lag. You even called it sometimes like 6 months lag, right? Well, we're starting to get to that point towards the end of the year. Are we really going to start seeing the effects of all these interest rates start showing up in the economy? And what do you think will happen as we start getting that effect to leak through?
Well, the main effect of the interest rate increases year to date has been to take mortgage rates up, to put an end to the housing boom. I mean, we've had housing prices down about 3 months in a row. We're definitely seeing it in rents, but the way they calculate shelter in the CPI and in the PCE is complicated, and it's lag. You kind of own your house and you rent it to yourself, and they use some lag formulas, but that will start showing up by the spring of next year. So, we know that's happening. The other effect of the higher interest rates has really been on repricing equities. I mean, you take the 10-year from 1% to 4%, now back to 3.5%. I mean, equities got competition now. In fact, they got competition both from the 10-year and from cash. Equities are probably only forecasting a shallow recession because most of the drop has been to deal with the competition they've got from fixed income.
What would you say? I mean, I'm looking at the numbers and I just kind of feel like it's going to take a long time, maybe much longer into 23 and 24 and 25. I mean, they ratcheted it up, and I can see why the market's reacting like it is. I mean, it just seems like it's going to be up there, and it's going to be, it's going to be stuck. I don't see what they can do. I mean, the rates, obviously raising rates haven't done the trick. I mean, what else can they do besides what they're doing? And 5%. I mean, doesn't that seem like just far away?
Well, the relationship between interest rates and labor markets isn't very tight. And particularly coming out of a pandemic, it's not very tight because, in the spring of 2020, we had a huge shock to the economy, the pandemic. And then we went into intensive care, and they gave us an incredible amount of drugs, namely $3 trillion of fiscal stimulus, and then the Fed bought $3 trillion. So the economy has to deal with the shock to its system from the pandemic, and then it has to deal with the side effects of the cure, and that's where we got our burst of inflation from. But, if you're expecting inflation to go back to core inflation to go back to 2% by the end of next year, hey, I'm going to be disappointed too. That's not going to happen, I don't think. On the other hand, if you want to see core inflation drifting down, I think that'll start from the spring of next year in a meaningful way. And we already have the headline inflation drifting down. So it's just a question of whether you're interested in the direction you're going or whether you have an endpoint you have to get to. And if you have to get to that 2%, then that's going to take a lot longer.
All right, Blue. Now, one of the comments that I caught yesterday, of course, was when Powell said doesn't have a plan to pause or take reversal path, right? You just mentioned it there that you don't see kind of core inflation coming down below that 2% in 23. So could we be seeing a prolonged time where interest rates don't get cut? Could be maybe even leading into 24. Could you see this being a possibility?
That's definitely one scenario. There are quite a few scenarios out there, but that's definitely one of them. And that one would occur in the situation where the unemployment rate doesn't go up very much. So maybe the unemployment rate ticks up to a little bit over 4, but doesn't go up very much. Core inflation's come down to 4. In that situation, I think the Fed would just hang around that 5 for a little longer and see how things are going. They'll be pleased by the fact that core inflation's coming down, but they won't quite understand how it's coming down without, the labor market's still strong. So that's a scenario, but there's the deep scenario, the deep recession scenario, which I don't give much credit to, but it's possible. And then there's the inflation doesn't come down scenario, and that's the Fed has more to do. The data's not suggesting that, but you have to keep your eye on that.
Okay, we're on the line with Blue Putnam, the chief economist over at the CME Group. You talked about the Tina trade. The Tina trade being dead as far as there's no alternative. Do you think that the malaise that you have in the market is just that people? What we've seen evidence in the market last couple of days is they're just selling pops and willing to get out of stock and put it back in. I mean, is that just going to be the trend for a while? I mean, 2-3 years where people are, hey, I know I'm going to lose out to inflation, but it's better than watching my stock go down 2, 3, 4%, or having that kind of year. What's your outlook for investor psychology on this? Like, I'm done with this market. I got smoked in growth stocks. I got smoked owning Target. I got smoked owning this and that. Are we coming into like a generational shift here where like, man, my grandparents got burned, my parents got burned, I got burned, I'm out?
Well, I think there are some people that are saying that, but the more serious or the issue I think a lot of people have is that this is an extremely uncertain environment. And in the coming out of the pandemic, we don't know where things are going. We're talking about 3 different scenarios, and they all have their probabilities attached to them. So if you are uncertain and if you are conservative, this is the first time in 12 years you can park your money in cash and wait a while. Because, you're not quite keeping up with inflation, but, inflation expectations aren't where inflation is. They're much lower, much lower. The market is not telling you that inflation's going to hang around. So, cash is an alternative for people who simply want the option to wait. And for equities, the malaise you're talking about, the equity rallies, the last 4 or 5 big equity rallies were kicked off after a crisis, and then we went to 0 rates or 1% rates back in 2001, and they had the Fed behind the rally. The Fed is not there this time. So, you're going to have choppy equities for a long time. It doesn't mean they can't grind up. It's just not going to be smooth.
All right, so I'll come in here with one from the chat. Like always, we like to give an advantage here on Benzinga that we can get questions from the chat here. So we got someone out there, and that's literally his username, wants to know, why doesn't Blue give much credit to the deep recession theory? Love his opinion. Would love to hear his view. So why not in a deep recession? Why didn't you see that, Blue?
Deep recessions typically have a very, very serious financial problem. That is, the Great Recession, 2008, we had the financial system imploded with the, Lehman Brothers, Bear Stearns, things like that. And that caused a huge amount of deleveraging. The unemployment rate shot up over, to 10%. So people lost their jobs. We had the subprime mortgage crisis, so they couldn't pay their mortgages. They had to foreclose on their houses. We don't have any of that going on. We have a much healthier credit quality of the banking system. We have better credit quality of the people that own houses. No, people are not losing their jobs. There's no subprime crisis. So we're not going to do what we did in 2008. And then you got to go back. It was a pretty mild recession back in 2001. We didn't even have 2 quarters of GDP go down in a row. It's just a slowdown. Then you go back to the S&L crisis of 1990. That was a little more serious, but that was a financial crisis. We had a whole part of the banking system in trouble. I'm not in the it's going to be a deep recession unless you have some kind of serious systematic financial problem. And I give that a very low probability.
All right, so you heard it there. Blue doesn't, I guess you don't see anything breaking, at least anytime soon. And I think that's...
Well, nothing really big breaking. Lots of little things can break. I mean, you can be, there's plenty of companies that would argue that they've had some issues, but it's, we're 10,000 feet looking at the market as a whole. We're looking at the system as a whole. It's in way better shape than in the past deep recessions.
All right. Now, like always, one thing that we always want to keep in mind is kind of the business cycles, right? Now we're getting towards a point where, what would you say here, Blue? Are we closer towards the end than the beginning?
Business cycles are best forecasted looking backward. If you look backward, they look like cycles. But when you're in them, that's not how they behave. They're all different. Every one of them is different. And this one is really different coming out of a pandemic. I think we're actually in the early stages of recovery from the pandemic. Not that we're in the late stages of some longer business cycle. And I think this recovery, it's like the economy has long COVID. We had a bad case of COVID. And then with long COVID, you get 3 months later, you get another symptom. 3 months later, you get another symptom. And that's where the economy is. We're still kind of dealing with where's the balance, where the decision's going to be. But we are doing way better. There's no doubt about that. The economy's not in that bad a shape, even with the Fed having raised rates. It's just a certain pocket. So, I'm going to be the glass as half full economist today.
Can't blame you on that. And who knows? Maybe it's half empty for some, but I do see it half full also for myself, Blue. We'll see what happens in the markets, and we'll definitely bring you back on in the beginning of the year. Excited to hear from you. Like always, our boy Blue, CME Group. Blue Putnam, we'll have you back.
Appreciate you very much.
All right, there you guys have it. And what are you seeing in the markets, Joel? Are we still
melting away? We're melting. I mean, there is. You took out that low from yesterday. I mean, there's nothing in here until last week's low. We could look at that at 39.45.75. But once again, I mean, there's selling pressure on this market. The ECB have bump. I mean, that I don't know if that was expected or not, but it's just you just don't have people. You're just not getting the buying on the dip yet, and I think they're waiting for the last week's low, which was 39.45.75. So also this is kind of typical expiration week action, right? Volatility, but right now the volatility is to the downside. Triple D, you hanging in out there? What, are you seeing a lot of offers?
I'm trying, man. I'm just getting wrong side on a little bit of this stuff here. So it's going to be a rougher day, it looks like here, just from the day trading perspective. But I mean, this is the market we're in here. It's chop. It's going to continue to be chop. I think you're right. I think we looked to last week's low. Well, that low 391.64, I guess is from just looking back here at the dates here, December the 6th. So I think you're looking back to there. You're 20 handles away from there. That's the next logical bounce spot here. I mean, we just sold off straight 200 points from, where we were just literally
I was just looking at that
48 hours ago. So, I mean, now it's like, okay, it's on stocks now. I mean, you got to wait for a bounce here to get out of stuff now. I think you'll get the bounce. We got a nice bounce yesterday. Hopefully people were taking that opportunity to lighten up. We got a nice bounce the day before. Now you're getting the sell-off. I mean, I think we still chop around here a lot. Again, I still think the path for next year, I know they don't want to hear this, but I think it's lower. I think there's too many stocks that are sitting up here thinking that, it's, value. I'm a value stock, so I'm okay. I mean, Money Manager on CNBC, case in point. They're asking me, is buy Nucor. And he's like, well, I know I'm safe in Nucor because it's only trading four times earnings or 5 times earnings. These earnings are cyclical. I mean, what happens in a recession or a downturn is these earnings all of a sudden start to go negative on you. So, I mean, cyclical earnings are cyclical for a reason, is that when the economy goes into recession, they actually go down. A consumer staple continues to make money. Cyclical companies, you could go in and say, yeah, it's P is 4. So if it goes into, into a recession, it's P is going to maybe go 6, 7, 8. I can handle that. I mean, there is a possibility it could get ugly and it could go negative earnings. So, I mean, I'm not saying it's going to happen. I'm saying it's a possibility. It's very, ignorant, to say that, P is 4, so I'm perfectly safe. I mean, I've been in PE4 stocks before too, and all of a sudden the business cycle turns the other way and they're not making money. And you're like, wow, that was a value trap. So, I mean, I'm not buying Nucor at 145. I think we're going into a recession. I think it's had an incredible rally. I think there's value traps all over the place here. I'm going to go take a line from Kathy Wood and say, I think there's a bubble in value stocks. I really do. I think we've had too big of a run here for the Dow in the last 45 days. And I think time to ring the register. A lot of these stocks are still sitting up here. I mean, the Dow hasn't even really come off much. So, we're 285 back in October. People were puking their guts out. Now we're 336, and I think we're going all-time highs. I think it was just the wave up, and I think it's an opportunity to lighten up stocks.
Well, you guys got it there on the outlook for value stocks, right? We're going to keep going. Any levels you want to give there on Nucor, Joel, just so we can move forward?
NUE, let's see how that's move. I mean, it's down 293 today. I just go real short term here. I don't 145. I mean, had a couple lows in that area. Monday's low 44.36. After that, you got a trap door down to like your 3-week low at 140.75. So better hold here. We're already through yesterday's low. Coming back on the upside here. You could get a gap fill at 146.01, a little bit of a rally, and I'm sure you'll see a lot of offers if we get close to unchanged at 147.93. Just take a look at Still Dynamics, which I got a little bit of, and I would like to get rid of that. Look at that pulling up at all-time high.
It's an all-time high. Is it not an all-time high?
Yeah.
I'd like to get rid of that. Why not? It's at an all-time high. I mean, I know people have this in their head that you want to buy, and again, everybody has traded the same pattern here for the last 6 years. You buy stocks in uptrends, you sell stocks in downtrends, and that's true unless we're going into a recession. Then you just take the profits and everything.
Yeah, I think why some people are looking at materials more often is that they're expecting a huge downturn in the dollar, and then with that, they expect to see kind of some of these get lifts from that. So I think
if you're expecting a downturn in the dollar, you're expecting a market rally. Because everybody looks at the currency when they should be looking at the equity markets. The equity markets have been leading this dollar for a long time here now. The equity markets sell off, the dollar lifts. The equity markets start to rally, the dollar dips. I mean, all the currency traders, I know you want to interrupt me because you don't believe that. But
no, it's not. That's not why. I just want to bring us to Tesla. I just want to make sure we cover Tesla here before we wrap up. It's about 8:57, so we only got 3 minutes of Joel.
Go.
Don't want to leave. Don't want him to run out on us. Tesla, of course, don't take maybe too many pages from Kathy. She's still remaining bullish on Tesla with another $11 million stock buy. But that's not the important news in Tesla today. It's all about Elon Musk, of course, selling another 3.6 billion worth of shares on Wednesday. The billionaire sold 22 million shares of Tesla, according to the file. Now Musk has almost sold 40 billion of the stock's worth in the past year. Is this going to stop leaking anytime soon?
Boy,
I don't know.
oh boy. Oh boy.
Well, again, to what I'll just say what I was saying before is I'm just as much as I'm selling stocks in uptrends, I'm not buying stocks in downtrends right now. Yeah. I mean, this is just value multiple contraction. We don't know the damage to the brand. The stock goes down every day. It seems like it's oversold. There'll be a bounce. The bounces are going to be sold though, Joel. I mean, hard to get bullish here when the thing's still trading high multiple. I know, yeah, they're saying, well, it's only 29 times forward earnings. Well, as long as those forward earnings turn out to be projected to grow as much as the analysts are saying they're projected to grow, I don't think that's going to happen. So I don't want to own Tesla.
Yeah, still very high. 151.33 is your pre-market high. So if that holds up, you got a little, you got some chance of a rally, which you will see at some point in the day. The bottom of yesterday's range, 155.31. That's definitely achievable. 150 is kind of like a psychological level.
I'm going to interrupt you again, Joel. China's rallying here right now, so I'm not sure exactly what has happened here, but we've got China having a significant rally here right now. Alibaba has now went green. Keep that in mind if you're trading equity markets here right now. That can be a driver to turn us around here a little bit. I don't know what the news is here. We haven't seen it happen here yet. But Alibaba is green now. FXI has turned green. We are seeing a lot of China stocks blast off here right now. Somebody has said something in China. NEO is taking off here right now too. They're saying in the chat, yeah, it's up 3%. All China stocks just turned around on a dime. Keep that in mind. If you're trading stocks here right now, we haven't moved much on the S&P yet. I think that could be a catalyst to maybe give us a little bit of a bounce here.
Maybe something on COVID restrictions or something, right?
Probably.
Yeah, that would be my guess.
Yeah. Well, just to finish up with Tesla here, and the next monthly low is not for a long ways down, and so if you're looking at things on a monthly basis, 130.77 was your October of 20 low, and not only did Elon sell some Tesla, but I'm flat. I'm out of Tesla.
You sold Tesla?
Mm-hmm.
You're done. Mm-hmm. Wow. Joel, the buy and hold investor. You had that for a long time.
Yep.
Finally sold your Tesla out.
Yep.
Why now? Sell it. Why?
Yeah, why now?
Well, the investment committee wanted to sell it. And
she doesn't like Elon?
It's no comment. And she doesn't. She's not on
Same
Twitter.
Reason my wife's not buying a Tesla now.
Yeah. Say she's not on Twitter, but she knows what's going on with Twitter. And she also said she was sick of it going down every day. So so good. So I can.
She's not sick of Peloton though.
No, that's gonna take that one with us. I can't get her to get out of that. Maybe if it gets,
she ain't getting out of that
one. To the grave.
Yeah, that's a graveyard stock. But there you have it. Boy, oh boy, must sell more stock, whether the financing for the Twitter deal or whatnot. But I mean, he's selling at these levels. I mean, it's a lot has to be tied to Twitter. You just have to. I mean, this stock would be getting hit, but if it did have the Twitter overhang, you just wonder where the stock would be. You think it would be, substantially higher, but it's just kind of falling into the, the value, or unvalue, the growth stock with the high PE and it's just coming to roost. It avoided it for the longest time. So I'm going to wrap
I
things
think it's
up.
a good sale, Joel. I mean, again, I wish it would have been before, but obviously the stock has been getting hit here, but you can't argue. You made a lot of money on it. You had it for a long time. No, you didn't get the top, but I mean, you did really well in this Tesla. You bought that thing way back
like a couple years ago when
Yeah.
we went out to the mall and she saw the car. She's like, hey, that's not a bad looking car. But it's
Sometimes
late. It's
that
not.
works.
Yep, 9:02. I'm gonna hop that pre-market low. Let's defend that. Maybe get back up to yesterday's low at 97.25. So, Mitch, Dennis, I'll check in with you guys later on.
All
See you
right,
guys.
it's one of those days. It's gonna keep going. Dennis, go ahead. I know you.
I'm
you got
feisty,
so much
Mitch.
to do.
I'm feisty today, and I'm sorry for snapping here because this is a
It's
market
cool.
that's just crazy
hey,
here. I know
I
I've
just
been
try to bring the
feisty with the
headlines.
chat. I'm definitely in a feisty mood. You can tell it here today. So, all right. Thanks, guys. Take
Have
care.
a good one, Dennis. No stress. And like always, team, one of the things that I'm always going to do for you guys is I'm trying to get to the headlines, right? You guys will see me sometimes interrupt Dennis, sometimes interrupt Joel. The main thing there is that we all know how Dennis can keep going on those rants. And like always, one of the most important thing is I'm trying to get you guys all the headlines that I have. So you guys can't say while you're done with pre-market prep that we didn't give you the facts, the news out there, the headlines. That's what it's all about here. Of course, we're trying to give you guys an understanding into the market. And like always, there's going to be some interruptions. There's going to be some breaking news. We're going to always try to adjust and try to do our best. I hope that you guys enjoyed today's show. Pre-market prep. Thank you, the CME groups. Of course, Blue Putnam. You guys, go give my man Blue a follow. Go give the CME group a follow. And like always, you guys can use this QR code right here and check out some expert insights and analysis from the CME group. Get it today, or just go to CME Group's website and you guys can also pull it up. You guys will find that in the description below. I will go ahead and now kick it to Benzinga TV. We got some live trading action. We got Benzinga live and of course, stock market movers. Stay tuned, team. It's going to be a great one. Lots to talk about, lots of movement. We'll see what's going on with the China stocks. They're even moving big. But like always, hit the thumbs up if you guys appreciated today's show and everything that we do right here on Benzinga. See you next time, team.